So actually this chapter has two components to it, the accounting periods and methods, and that's, maybe the first 7 or 8 slides. I mean, I am going to go through it, but that's not where the emphasis is going to be in this chapter. The emphasis is going to be on depreciation because in and of itself that is a topic that really pertains to a lot of people. If you've got a small business and you have any fixed assets, you have to fill out a depreciation schedule. If you have a rental, you have a depreciation schedule. If you have an office and home, you have a depreciation schedule. So it's inherent in a lot of things. But let's just spend about the first 10 minutes taking a look at accounting periods. So almost everybody individuals file a tax return with a year-end what? When's most of our year ends for our individual tax returns? Yeah, December 31st, right? It's a calendar year. Okay? And if we all own together a partnership or a corporation, it would be very likely that our S Corp or our partnership would have the same year end as what most of our individual year ends look like. But there are organizations, and I've had a couple, not a lot, you don't see it a lot, but I have had companies, corporations or S Corps or partnerships that have a year end that's something other than 12/31. And that makes things quite complicated because the partnership of the S Corp closes out their year, for example, in October, but you're filing a 12/31 tax return for an individual. So I'm not even really sure why they introduce this, because then they go on and say the details are beyond the scope of this text, which it is quite complex. Like I said, I think I've only seen it 2 or 3 times in all my years of practicing, but just be aware that can occur, and if it does, that you need to do some research before you can take them on as a client or prepare their tax return, because there's some estimating and projecting to do. This happens a lot. I've seen this a ton. Let's just jump to the example and then I'll make my point. So in 2014, Organic Dairy LLC changes from a calendar year to a tax year ending September 30th. Or, well, okay, let's just stay there. And so you've got really a short period for this client because they've changed their tax return to a year end that's something other than calendar year. Why would a company do that? That's exactly why you do it. You do it because you want your fiscal year end to emulate your natural business cycle. So I don't know anything about the dairy business, but when I made this example up, I must have been assuming that the busy season ends, the cycle kind of ends around the end of September. And there's a lull in the winter months. So I want to end my fiscal year in connection with my natural business cycle. So then it says for the short period, 1/1/14 to 9/30, they had taxable income at $20,000. How do you calculate the tax for that time period? And is the question here, and that's what the slide's trying to display. So you've got 3 steps here at the bottom. The first is you need to annualize the income. So if I earn $20,000 in 9 months, how do I gross that up as if it were a full year? Go ahead. Exactly. That's it right there. So 20,000 divided by 9 is going to tell me how much I'm earning monthly, and then I multiply it by 12 months to annualize it. I just put it all in one fraction, 12/9. But what Jess said is the logic behind it. How much am I making per month? And then gross it up as if it were 12 months. So if it were a 12-month period, if I was performing the last 3 months like I performed the first 9, I would have earned 26,667. You have to estimate the tax on that and then allocate it down to the short period. So basically what I'm doing is I'm taking my income up and annualizing it, figuring out what tax would look like on that full year, and then bringing it back down to the short tax period, and that's what I'm going to have to pay.
And where was the estimated tax from? Is that just taking it off the table?
I would have taken that off the table. I just made it easy here, but yeah, you would have taken it off the table. Yeah.
So you would have a short year if you went into business mid-year.
If you
started
change.
business mid-year, or if you changed your business.
If you started mid-year, you wouldn't have to do this because you wouldn't need to annualize because you really only started business in, July.
Well, I'm saying the only 2 reasons you'd have a short year.
Yeah.
Or if you change your fiscal.
Or there's a third reason. So can you guys hear Jess? She's saying, what are the reasons that you would have a short tax year? This is one of them. The second one is just what she said, which is I didn't start business until July. So my first year of business, I only, was in business 5.5 months. The last reason that you would have a short tax year is if you changed your type of entity mid-year. What the heck do I mean by that?
From an LLC to maybe an S.
Sure, exactly. I decided to go from an LLC to an S corp, or a sole prop to an S corp, or a sole prop to an LLC, or whatever. I change my entity type mid-year. When clients come to me and say I'm thinking about doing that, I usually encourage them to try and do a 1-1 change of entity, because I'm going to have to do 2 tax returns for them then. And so it's just going to double their tax bill, right? Unless there's a really compelling reason they need to do it mid-year. Which for me would really be their attorneys telling me there's a really compelling reason they need to do it mid-year.
I have a question. Fitness, where, so like your tax year is differently with the government, their fiscal year or something in October. So would their tax return, or would your tax be their calendar year maybe?
Their calendar year would be 9/30. The university ends its fiscal year on 6/30. So our budgets are 7/1 through 6/30. But neither the government nor the University of Montana file tax returns per se. So they're nonprofits.
Okay. We could still
Okay, super good question. This is really salient. Jess asked, well, so what if my year end is 6/30? How do I run my W-2s? Can you run your W-2s with a fiscal year that's not a calendar year? No. So that's an additional challenge if you're somebody that's got a year end other than 12/31. That's a real pain in the ass because you've got to merge your 2 fiscal years to run a calendar year report, like a 940 and a W-2 and a W-3.
So do you end up pretty much having to keep track of like your employees kind of with payroll?
You do. You're going to have a separate payroll module. It's a royal pain. You've got to have a really compelling reason to do this because it causes issues everywhere.
And like with the fiscal year is not the same as calendar year.
That'd be about right for the government.
Yeah, it makes sense if you're doing it wrong.
Okay, so then this chapter, so that was the accounting periods. Then this chapter talks about accounting methods. There shouldn't be anything new here. Each of you should easily be able to kind of reiterate this whole slide. How does a business, what kind of accounting methods do businesses use? They either use cash in, cash out, or accrual, AR, AP, or most commonly for most small businesses, they use a hybrid. which means they do some depreciation and some inventory, right? And then take their inventory to cost of goods sold as they sell it, but they don't go through the whole accrual of wages payable, interest payable, accounts payable. So it's mostly cash in, cash out, but they do depreciation entries for fixed assets, and they manage inventory versus cost of goods sold on an accrual basis. And I would tell you that's 90% of my small businesses. You have to use the same method for your tax return as you do on your books. And I've only done one of these in my whole life, this last bullet, where you want to change accounting methods. I had a mechanic, a transmission shop, that wanted to go from cash to accrual. She'd been to some conference, the wife of the guy that owned it, or they co-owned it, whatever. She'd been to a conference, and they were like, you should totally be accrual, it defers taxes. And she came back, and I tried to explain it to her that, I mean, it was going to happen 1 year. She was going to defer her taxes 1 year. So she's only going to have a benefit one time. And it was a 25-page application to the IRS where you had to restate all of their old financial statements for 7 years as if they'd been done in this other method. I mean, I think I billed her a couple grand to do it. I mean, it took me forever. And anyways, so you don't really see that very often. Really what I want you to know is up here, cash, hybrid, and accrual, and what is that? You know all this. What cash is, it's just cash in, cash out. You can't use cash if you're a corporation, a C Corp, or a partnership that has not just individuals, but other corporations or other partnerships as partners. This gets kind of complex. In our little world, most of our clients aren't any of these things. I think I've only got one C Corp. The rest of them are all S Corps, partnerships, or LLCs. Accrual method, you know what that is. Hybrid method, I just described that, cash in, cash out, but you accrue for your inventory and you depreciate your fixed assets. Okay, can somebody define depreciation for me? What's the act of depreciation? Okay, you were totally correct up until the loses value part. It's the allocation of the cost of an asset over its what? Useful life. Does depreciation have anything to do with value? Because some assets, like a building, are going up in value, right, from an appraisal standpoint, as we're depreciating it. So never ever use the word value when you describe depreciation. It's the allocation of the cost over its useful life. And when we were doing, I don't think that I had any of you for accounting too. I haven't taught that for quite a long time. But does anybody remember how you found useful lives for GAAP purposes, for financial statement purposes? It was. It is. It is. Exactly. Am I using the truck to putz around, the Bronx, or am I using it to...
Yeah, the same truck could be used by two different companies for different purposes in the last 20 years.
Exactly. But that's not, so, and that was kind of how it's presented in accounting too, in financial accounting, like you determine, right? The reality is what Sarah said. The IRS gives us tables, and they tell us how long the stinking truck's going to last. Okay? And you can go ahead and do whatever well, I'm not even going to go down that road. So let's just say, in reality, all of my clients for sure, and none of them would even really probably know to question this per se, all of my clients, I depreciate their fixed assets on their financial statements on the same schedule that I do their taxes. Because otherwise you're going to get pretty messed up because your taxable income on your books isn't going to equal your taxable income on your tax return. And then that's getting pretty screwy. So just kind of go over basics. It's the process of allocating and deducting the cost of assets over their useful lives. It does not mean devaluation. You all know land is not depreciated. And I think in this class we practiced when you get title to a piece of land or to a building or a piece of real estate, what's the first thing you have to do before you set it up on a depreciation schedule? So I've got a buy sell, and it says my purchase price is 1.8 million, and there's two sets of closing costs, right? Who pays closing costs? The buyer and the seller, right? So I'm buying this, and this is how I always remembered this. This is just one of my little mnemonic aids that I used for myself when I first started practicing tax. If I'm buying, the closing costs are added to basis. If I'm selling, I subtract it. In other words, deduct it, right? And that's what we've been doing. Yes. So what I'm saying is it depends upon which end of the transaction you're on, what you do. If you're selling, it's a deduction, right? Those points and any real estate taxes, the mortgage interest, and so let's say on a $1.8 million building, I had, let's just write that out all the way. Let's say that my closing costs were 60 grand. So the reason that I did that is because those closing costs go into my basis and are depreciable. I can't write them off straight away. So my next question is, if I just bought a building, let's say I just bought the Butterfly Herb building in downtown Missoula, do I get to depreciate this whole thing? Why not? Is the building floating above the earth? No, it's sitting on land. So a part of that, if I took that building and raised it, right, or demolished it, I would still have an asset, wouldn't I? Pretty dang valuable asset, because in Missoula, because we're geographically constrained, land is extraordinarily valuable. And it's an asset that doesn't depreciate. So you've got to come up with some, of that 1.86 million, what percent of it's allocable to the building, and what percentage of it is allocable to the land? And honestly, I don't really think this number is probably that valid, but when I was trained here in Missoula 20 odd years ago, I was just always trained, you take about 80% of it to the actual real estate. The rest of it is non-depreciable land. I don't think that number probably holds anymore. I think land's gotten a heck of a lot more expensive. So probably only 60% of that number is allocable really to the building. But you want it.
Is there a way to find that out?
There is if you have a form, if you've had a formal appraisal, and you can get a copy of a formal appraisal, it'll say like, that'll even take you down to the HVAC system versus the actual building envelope versus the land versus, things like that. At any rate, just be aware that with real estate, you can't just go to the buy sell and pick up the number that I bought it for. You've got to add the closing costs, and then you've got to figure out some percentage because it is not all depreciable. Well, actually, no. It's like the underwriting fees, the title insurance, the appraisal costs, the, oh gosh, the wire transfer fees, the, just all those ancillary costs that go around it. Because if part of my closing costs were mortgage insurance and real estate taxes, those are what? Those are our deductions.
And then you allocate them based on the new owner first.
That's already on your closing costs. That'll be on your buy-sell. And that's what the buy-sell does, is allocates it. Good question. That gets, buy-sells and real property, that gets a little tricky, doesn't it? But honestly, those are for sure transactions you would have to handle because many of your clients are going to buy and sell a house or a piece of rental property or a piece of investment property. So depreciation goes on a Form 4562. So I think we should probably all find a 4562 and kind of be looking at that while we go through this process. And I'm going to probably just try and pull mine up on online. When you find one on a page, let everybody know. Okay, does everybody have one in their book open? Chapter 7. Got a page number? 7-41. Let's just start before we kind of jump into the meat and potatoes of this, looking at the Form 4562 because there's a lot going on here. You're not going to really know what all this is right now. But if you've got a hard copy, you might get out a highlighter, write notes on it, or whatever it's going to do to help you kind of know which parts of it to use. The first part you can see is the election to expense certain property under Section 179. We'll talk about this. I don't know if we'll get to it today necessarily. It might have to wait till Thursday. But this is the part of the 4562 you use when you can just write off a chunk of your asset in the year you bought it. That's the whole first part, lines 1 through 13. Election to expense certain property under Section 179. The key word here is expense. In other words, I don't have to set it up and write it off over 5 years or 7 years or whatever. I get to expense up to a certain amount all in this year. And you can see there's lots of limitations. You got to do a lot of calculations. It's not just a slam dunk, but I'm just trying to give you an overview of the sections. So that's obviously desirable for a business, right? I get to write it all off this year rather than over time. I get a really big deduction right now. Go ahead. Yep, and we'll look at all the limits. Section 2, let's skip that for right now because that's in transition. Part 3 is where dang near everything's going to go, or the majority of your assets are going to go. And I think you've seen this before when you did your assignment 2, right? And then there was also, when else did you see a 4562? Is that the only time on assignment 2? At any rate, line 17 is a very innocuous, simple-looking little line, but you're going to usually, if you've been in business for a while, have a pretty big number in here. It says, makers deductions for assets placed in service and tax years beginning before 2014. So that's all the depreciation on all the assets that you bought before the current year. So it's just going to be one number, but we're going to spend time on Thursday learning how to construct a depreciation spreadsheet in Excel that helps us calculate that number because, I mean, it's just one number, but there's a lot that goes on behind it, okay? This whole area is just what it says, Section 18B, assets placed in service during the current year. So the only thing that goes in Section B is stuff you bought this year. That's it. And we're going to spend time looking at this as well. But what I'm saying is, they have been buying assets for 15 years. Those are all going to be in one number on line 17. The only thing that's in line 18 is my new stuff. Then you can see down in part 4, they want a summary. And it says listed property, enter amount from line 28. So let's go to the next page and we'll see that that's what part 5 is listed property. And it tells you exactly what it is. This is a special section where you put your automobiles, your aircraft, computers, and property that are used for entertainment, recreation, or amusement. So I've got a ranch and I've got some ATVs or some snowmobiles. I've got an airplane, any of my vehicles other than delivery vehicles. So all those special things that have a high propensity for abuse, right? Like I've got an airplane I'm writing off. Okay, I want to see that you've got a $3 million aircraft that you're writing off. I don't want it buried in the fixed asset schedule because that has a high propensity for abuse. Do you really need to be writing off an airplane to conduct your business? The IRS wants these items pulled out. So that goes in Section 5. And lastly, Section 6. And you can see again, this is split into two parts, line 42 and 43. 42 is for amortizing anything that you acquired during the current year. And 43 is for every amortizable item that you've acquired in a prior year. And what kinds of assets do we amortize again? Probably week 4 accounting too. So long-term what? Like my building goes here? Starts with an I. What kind of assets? Intangibles. Intangibles. My assets I can't touch. My patents, my copyrights, my goodwill, my covenant not to compete. Okay, we're going to look at all this in more detail, but I just want you to see the snapshot as we start going through the slides where these things are going to end up and kind of start thinking about where do I think this is going to end up on the 4562, because it looks like a pretty simple form. Well, it doesn't even really look like a pretty simple form. So just start kind of envisioning where you think it's going to go. Okay, so with that in mind. So the first bullet here talks about straight line depreciation. It says straight line depreciation is easiest. It's just cost minus salvage divided by the number of years. And as Jess was saying, that's what we thought we were doing in accounting too, right? As we were trying to figure out the life, How long am I going to use it? How much am I going to sell it for at the end of its life? And then we would do this math, right? Well, that's not what we're doing for tax. And in reality, like I said, I keep all my clients, whatever I figure out for tax is what I use for their books, not this one, because then you've got all this reconciliation to do every year, and that just adds billable hours to their tax return, and it doesn't really provide any value. What do we use? We use this mouthful called MACRS. Modified Accelerated Cost Recovery System. What does that word accelerated mean to you from a depreciation standpoint? The depreciation is sped up. It's definitely sped up, and it's so what is this? Is the years. This is the dollars. So basically what it's saying is this is your depreciation line. So it's high, very high in the early years, tapering off as it gets further down the line. MACRS specifies the years. You don't get to choose the years. You have to go to the MACRS tables to find the years for any specific asset. This is going to cause you a lot of angst because they're very vague. The reason this is set up as it is if this is your depreciation line, this is generally what repairs and maintenance looks like for an asset, isn't it? When you buy something new, you're not spending much to keep it going, hopefully. As you get down the road, that's probably going to be higher. So the theory is, from a tax deduction standpoint, that it kind of evens out. Good question. And there are some different rules for used assets and new assets. This should look familiar to you. What method, do you guys remember back to accounting 2, what method you used that looked like that? Which one? I think it was DDB, double declining balance. That was the method that you learned in accounting 2, and that is what MACRS is based on, is DDB. We're going to just use tables. You don't have to do the calculations because they've done it for you and put them in tables. But if you were ever curious, like, oh, I wonder where all these numbers came from, it is double declining balance.
So,
Go ahead.
so the three types of depreciation methods are straight line. What is the other two?
I don't even know. Did you guys learn some of the year's digits or units of production? Does that sound familiar? Units of production, and then straight line, and then DDB would then just be the 3 ways you learned. Some of the year's digits is sort of antiquated. Yes. So MACRS is what we're using. It's premised on double declining balance. It allows capital assets to be written off over a period identified in tax law. We're going to look at tables. They're going to tell us how long you get to write off a horse versus a tractor versus a piece of research and development equipment. We use this accelerated method for everything other than real estate. Real estate does not use accelerated. They use straight line, but the tables are all there. Okay, the next thing that I just need to, because I don't feel like these slides make this 100% clear. So the next differentiate, or the first kind of differentiation you have to make is what I'm talking about personal or real or intangible? Intangible is what again? Stuff I can't touch. Like, I buy your business, and, huh? Yeah, goodwill. Yeah, goodwill, exactly. That's an intangible. I bought your client base. I bought the fact that you're located in the best corner in town. Okay, that's goodwill. And that's very straightforward. Do you remember which part that goes in? On your 4562, you can take a peek. Yeah. So we're going to learn how to do that, but that's super straightforward. Okay, real estate is either residential or non-residential. Which is just a fancy way of saying commercial. Residential real estate means that 80% or more, wait, did I say that right? Yeah, that at least 80% of the units are occupied by people, individuals. So you can have mixed use where you have an apartment building and then you've got a couple like a coffee shop on the first floor. But the math is 80% of the square footage. And those guys go over 27 and a half years. Long time. Yeah. Go ahead.
So after you fill out your 4562,
Yeah.
where does this go?
Well, so your attachment sequence, you mean up in the top right?
No, I'm just trying to understand how this.
Oh, okay, great question. So her question is, once I do the 4562, where does it go? Can you answer that easily?
No.
It could go to where? Which form could it flow to? Name one. An A. It could flow to an A if you were depreciating a vehicle as an employee on your 2106. It could end up on an A. It could go on an E if you're depreciating your what? Your rentals and your snow plowing equipment you use to keep the parking lots clear for your apartment complexes, right? And your asphalt equipment and all the stuff that goes with your rentals. It could go to a C. No, 4562 is never going to go to a D. Could absolutely go to a C. My business. Like when I buy a new computer for my little tax business, of course I do a 4562. An F, I've got a couple farms, farm equipment. 4562 flows right to that. And then it also flows to all your corporate LLC, S Corp tax returns as well. So they can end up lots and lots of places. It's a really basic form for a lot of things. No, that's a great question. Non-residential or commercial, 39 years. What part do these guys show up on? Take a second, look at your 4562. Start to familiarize yourself with it. Yeah. And it totally depends upon whether you bought it this year or any other year before this year. Personal is everything else. The word is kind of misleading. It makes it feel like, your intimate personal items. No, it's just everything that's not real estate or not an intangible. That's depreciable.
Are you allowed to depreciate your floor?
Yeah.
Even from the business use?
Nope. And there's lots of things that can happen to this. They can be, that's section 179 that we looked at up in part 1. They can be in, so that's part 1, right? They can be in part 3. Just regular old makers. Or they can be in part 5 as listed property. So these things can be all over the place. With makers, each asset, so we're talking about personal property now, right? I just did personal versus real versus intangibles. Personal property, go ahead.
So it's part 1, 3, and
5 for listed. With makers, each asset is depreciated according to an IRS specified recovery period. A recovery period is the IRS's fancy way of saying how many years do we write it off over. And almost, probably 90% of my assets that I write off are 3, 5, or 7 years. With my farms, they have some 10 and 15-year assets like sheds and outbuildings. If somebody goes and like paves their parking lot or puts up utilities or does fencing, those go over 15 or 20 years. But for most of us, the majority of what we write off are 3, 5, or 7 years if they're personal property. Well, how do I know how long? It says CPA Table 7.1 on page 7-7. But that's just not that helpful, honestly, for you guys, I don't think. What do I write off over 3 years? 3-year assets are 18-wheelers. Horses. It's about the only thing I can think of off the top of my head. 5-year cars, trucks. Most of your, qualified technological equipment is like when people buy robotics or computers, 3D printers, energy property, your solar panels, your turbines, your geothermals, anything like that, research and development property, anything they use in a lab, all your computers. And then 7-year is for your furniture, your office furniture, your fixtures, like I bought a new lighting system. I bought I don't know, what else is a fixture? I made pods in my office. I brought in I did, but it's not leasehold improvements. A leasehold improvement is when you lease a space and then you go in and put up like your own shelves and lighting, but you don't own it. That's not a 7-year property. That's a leasehold improvement. That's 15 years. These tables are really hard to use because they're super vague. I know these things because I have to look up individual situations all the time. I'm like, I don't know what the hell to do with shelving. So you look it up and you learn, oh, it's a leasehold improvement. I'm going to show you where to do that in the tax law, because this little table that they tell you to use is totally insufficient in my mind.
Well, if you own a building and you like fix up the inside, you're putting in the actual shelves and everything else like that, then
No.
it would be the 15-year for the person
That's leasing it.
Okay.
And that, you guys, that's hugely tricky. What happens when you put a roof on your building? That's where it really gets to be a bear. I don't want to write this frickin' roof off over 39 years. But it turns out, I mean, and I have researched this every way but upside down, because you have a lot of clients obviously re-roof, do a new HVACs. Capital improvements to your real estate has got to go over how many years are left on it. Just see, this gets pretty in depth pretty quick. Great question, though. So I own a fourplex. So is that residential or non-residential? Residential. And say I bought it in 1995. Stick with me here. And in 2012, I put a roof on it for 10 grand. The question is, the client wants to, what does the client want to do with the roof? They're like, I just spent 10 grand on a roof. What do they want to do? Yeah, well, they're not going to get reimbursed per se. They want to write it all off. It's like I had a repairs and maintenance expense. It will go on your schedule, but it's not a repairs and maintenance. Like if they go in and put in a new water heater for $800, sure, I take it right to R&M. Repairs and maintenance. What? Why isn't a roof? What's the difference between the roof? Okay, and how do you make that differentiation? It's a capital improvement. It definitely is.
It does raise the value of the property, right?
It's not so much it raises the value as it. Well, and you can get in, when you get into tax court research, they talk about, did you do just the shingles, or did you do the felt, or did you actually do some of the sub-roofing structure? I mean, it gets a little crazy. But on the whole, just to keep it sort of simple, a roof generally extends the life of your capital, of your asset, and that's what a capital improvement is identified as. Something that extends the life of your asset. So does the water heater in one of your 4 units extend the life of it? No. Does pouring a new foundation extend the life of it? Probably. Right? Does painting it extend the life of it? Painting's R&M. You can put painting through R&M. Repairs and maintenance. In other words, write it off immediately.
I saw a show a few years ago where they were looking at trying to put something in the paint.
Nano,
on
yeah.
your roof and it would add like a solar.
Yeah, it's nanotechnology. Now that because that paint's about $200 a gallon.
Right.
You're actually adding energy to your roof by painting it.
So then would that be?
Well, I'll tell you what I would do as an accountant. I would try and write it off immediately, because it's probably never been to tax court because it's so new. You know, I mean, you know. The other thing is when you talk to clients, I'll tell clients straight away, as a person, I'm pretty liberal. As a tax accountant, I am very conservative. I don't want to go to tax court. I've never been to tax court. I don't want you to have to hire an attorney to go to tax court. So Here's maybe what some people would do is write it all off. I'm going to take it over the rest of the life. My point is now I want you to tell me this $8,900 roof, how many years are you going to take this thing over? So the question is, how many years does the fourplex set to go over in the first place? 27 and a half years, right? How many years has gone by when I get to the roof? 17. So how many years is this going to go over to expense it? Yes. So when I get to 2012, 17 years have expired. It's a 27 and a half year asset. I've got to match the roof up and expense it over the remaining life of the asset. So,
It doesn't increase the life of the fourplex on paper.
yeah, I know that seems like an oxymoron. I'm telling you, it's only called capital if it extends the life of an asset, but at the same time,
That 27 and a half years doesn't change when you make your application.
no.
So then you use
Yeah. Trying to think of other examples. And it's all, honestly, I have to look it up. Like somebody just came last year and they'd done all Trex decking and steps to the exterior of their building. And like in my mind, that's going to extend the life of an asset, right? Because you're not, but yeah, well, it didn't. I mean, when I looked it up and went to tax court, it was allowed, tax court allowed it to be repairs and maintenance. So you really, like this is obviously a slam dunk that it's got to be capitalized. Most other things I have to go look up.
What about the windows? Like if you put all these windows in your building, big picture windows.
That's a great, no, it's not. It's somewhere in between there. When you look that up, that goes over, it's got its own asset schedule. I think they're like 10 years or 7 years. HVAC systems, I believe, off the top of my head, are 7-year assets.
With those windows, they only have like a 10-year life, maybe from this fourplex 1995, year we're basically 2012. That's it.
No, what I'm saying is on building, when you go into tax code, all those different elements you're asking about, what about the HVAC system? What about the windows? What about the, utility stubs for the sewer or something? Those all have lives that are individually, that gone to tax court and been promulgated. In other words, they've told us how many years they go over. Great questions.
When you hit that 27 and a half year
Yeah.
age of your asset, like, do you have to stop claiming the depreciation at that point?
You're all done.
Okay. But you can still, can you still claim, for the new roof and
Sure. Oh, sure.
that?
So Jess's question is, at the end of this, so when is this thing up then? 2022, right? I'm done depreciating it. But in 2022, I put 20 grand worth of solar panels on the top of my roof. Can I write those off? Sure. Just because the actual building's done doesn't mean that I'm not going to have ongoing, and then I repaved the parking lot. And in fact, I've got to look that up this year. We did some paving on one of our investment properties, and I want to take it as R&M, but I'm guessing the tax law is not going to let me do that because you really don't use up paving in a year, do you? My guess is, well, quick funny story about that. I go out and I'm like, holy crap, there's a juniper tree that's grown under the curb and is coming up through the asphalt, and they paved right over it. I am like, oh no. I'm sorry. I'm not going to be paying you until you come over, recut that out, get that root out from underneath. They're like, huh? Yeah. And it's like, I don't know anything about paving, but I do know that you don't just pave over a tree root and think that that's going to be okay. Crazy. And then, the other thing I wanted to show you here really quick was that what you guys were just kind of skirting around is that what is so awesome, and I think I've talked to you before, if you ever have a chance when you're buying your first house to get a duplex, or if you can ever buy investment property, is that in the early years, you've got really high mortgage interest, right? Unless you're somebody who pays cash for your properties, but I mean, for most of us, you're, financing it. And you've got your depreciation. So you've got positive cash flow. But a tax write-off. And I can tell you there's not another investment that I can think of, and I'm just totally making this up, it just depends upon, the asset. But say in the first 10 years, I cannot think of another asset that you're going to take $500 a month out of it and then get a tax loss. That's huge, assuming you don't have AGI of more than what? 100,000, you start to lose this, don't you?
So is that only with mortgage interest? Like if I go out and buy a mobile home, even though I'm living in a home, but I just need an interest loan to buy it,
Yeah.
can I write off the interest with that?
So you're buying it to rent it?
I'd be buying it to live in it.
Okay, if you're buying it to live in it,
Either or.
if you're buying it to rent it, then you've got a Schedule E, and your mortgage interest, I would actually have to look at that. I think to write off mortgage interest, it has to be secured by the property. I would have to look that up. Or you could look it up on your Schedule A publication. So, okay, let's just assume that we figured out what from that table. I mean, you're just going to have to ask me questions, and then I'll show you the page in the publication that you can look at for yourself. But you've determined it's a 5-year asset. Now, how do we calculate it? So the next thing that you do is you go to table 7.2 on page 7-8, and these are where your rates are, depending upon how many years the asset is and what year you're in. So you can see a 5-year asset, and the year you buy it, you're going to multiply how much you paid for it by what? 20%. And now I have a 7-year asset, and I'm in the 3rd year. I'm going to multiply it by 17.49%. Is there anything weird here when you look like under the 3-year schedule or the 5-year schedule or the 7-year schedule that you want to ask me about?
So where the stars are, it says with the straight line depreciation. What does that mean?
Yeah, they've done that. They do all the math for you. They're just letting you know we've gone from accelerated to straight line midlife. What's interesting to me is that the 3-year assets go over 4 years, the 5-year assets go over 6 years, the 7-year assets go over 8 years. That's because of something called half-year convention. That they assume that you bought the asset halfway through the year. So you take a half a year in the first year for like a 5-year asset, and then 4 full years, and then a half a year in the last year. You don't need to worry about that. The math is all embedded in the tables. All you need to do is flip to page 7-8 and pull the percentage off. Why you do need to know this is when we get to the 4562, it'll say what convention did you use. You're going to put HY in, half year. So the method is DDB, double declining balance. The method is DDB, but the convention is HY, half year. And it says right here, it means a half a year depreciation is taken in the year of acquisition, and a half a year is taken in the final year. We don't use salvage value with makers. You just take whatever you bought for the bloody thing and go straight to the table. What if you say, I don't want to use makers, I want to use a straight line? Why would you do that? I'm on the 3rd bullet, or the 2nd big bullet now. why would you say, I don't want to do accelerated depreciation, I prefer to do straight line?
It gives you less of a deduction, but for a longer period of time.
That's precisely what it does. It gives you less of a deduction for a longer period of time. The only reason I would do that is I don't really have much income right now to absorb my accelerated depreciation. So a huge write-off doesn't do me any good because I really don't have any income. But I think I'm going to have more income down the line. So I want to extend my depreciation. I don't want to lose this big accelerated depreciation now because I don't need it. I'm just starting a business, you know, so I really just don't have income to absorb it. Okay, let's see. Okay, and then so the straight line tables are on page 7-9, table 7-3. We do. Yes, we do, definitely. So, and then in 2013, one of the big issues you get in business, it's just like a very common question is, you know, like this would be one of my clients. I've got a pet grooming business, you know, that makes 25 grand a year. And I bought some new high-grade clippers for $400. What does she want to do with them? She wants to put them through supplies, right? Immediately expense them. And I'm saying, ooh, that could be a fixed asset. We might need to set that up and write it off over 5 years. The question is $400 a okay amount to run through supplies, or is it too high? What if the clippers were $1,400? What if they were $2,400? Right? What's that limit or that amount? And the tax code does not tell us that number. It gives us no guidance. It's completely gray. So that's one of those things like where I showed you the 80% is allocable to the building and 20 to land. As an accountant, you're just going, okay, well, I'm going to just make up a number and say anything under $1,000 we run through supplies. But that's not going to look the same for my $25,000 a year pet groomer, is it, as my $4,000 a year artist who does wood blocks. So it's like, I have no guidance. Finally, in 2013, the IRS gave us safe harbors for taxpayers wishing to expense certain items that may not be material. On page 712 at the top, non-inventory supplies and materials costing less than $200 may be expensed. In addition, a small business taxpayer originally expensed tangible goods on their books and records costing up to $500. The same expense recognition may be granted for tax purposes. So I'm reading all the way on the top on that tax break. They finally gave us a number, $500. So she wrote those clippers off on her books as a supply. I don't need to sweat and worry and, spend 15 minutes doing research on it and then bill her another $20. I can just say, cool, supplies. So we finally got a number. It's $500. Also, you don't have to spend all that time cluttering up your depreciation schedule with stuff that costs less than $500. So that was good. All right, let's try a couple of these. So on the first one, we have a company, Naturatech. They bought some furniture, so obviously they're furnishing like a whole new building for $180,000. What's the recovery period? What's the depreciation? So get me year 1 and year 2 on $180,000 of furniture, please. And then I'm just going to put it to another slide so that you don't see the answers. I don't know how them coming up there. So how many years do you think it goes over? Yep, office furniture 7. And then it's really just a matter of going to the tables, isn't it? And picking out the percentages. So when it's something that's easy to find on the tables, it's that complicated. What line on your 4562? So once you get those numbers, jot them down somewhere. Am I going too fast? Once you get those two numbers, jot them down somewhere. And then let's figure out how we think we would get them in a 4562. In year 1 and in year 2. You don't really need to worry about that. It's just telling you mathematically that's what's happened. Okay, so now we're going to go, does everybody have those two numbers jotted down? Let's go to our 4562. Where do you guys think in year 1 this furniture is going to go? Just whenever you get the line number, just tell me. I think it's going to go to 19C2, so let's try and fill it out. We don't even really know what Section 179 is yet. It might actually go there, but we don't know what that is yet. All right, 19C, so you guys can see I've got my cursor blinking where I'm going to go. And the first thing it wants to know is basis for depreciation. What is the basis for depreciation? 180, right? That's how much I'm depreciating. What's the recovery period? .0 years. What's the convention? HY, half year. What's the method? DDB. How much was the depreciation? I don't know, I don't have the number in front of me. Wasn't it 25 something? That's it. That's in the year that I bought them. And we know that because we're in Section B and it says assets placed in service during 2014 tax year. Okay, great. Now, obviously in year 2, I'm not going to still be on the 2014 4562, am I? I'm going to be in the next year's one. But we don't have that, so just work with me. Pretend like this is a 2015 tax return. We're on year 2, and now we want to enter these assets, or this furniture, on my year 2 2015 4562. Where does it go? Nope, because it's not placed in service during 2014, because now I'm in 2015, right? It just goes on line 17. And again, is there room to put anything in? All you've got is the number, which is what again? I think in year 2 it was less. Oh, it's more. It's more in year 2? Oh, yeah, because the first year is only half year. Okay. So in year 2, you don't re-enter all the stuff about the purchase price and the method and blah, blah, blah. You just pull the number. Where does that number come from? Do you guys remember, who was it that we did all the depreciation on, and I asked you to print the depreciation worksheet? In reality, what we're going to be learning how to do on Thursday is that number, that 44,042 or whatever we just put in there, is going to come from a fixed assets schedule that's going to basically look just like what we just filled out in Part B, but we're going to do all the details to it. So just so you can kind of see where we're going. Okay, so does everybody feel fairly okay about what we just did here on the 4562? All right, let's just keep moving forward just because there's a lot of content in this chapter. So then in the next one, what do you think a computerized inventory control system, how many years do you think that's going to go over? Look at your table 7-1. You think that's a 5-year asset, and I agree. So it would be the same thing, wouldn't it? You take that $12,000 to table number 2, pick up the percentages for the first 2 years. Five-year asset year 1, 20%. 5-year asset year 2, 32%. And that would go on the 4562 just like we just practiced with the other asset. You can't, trees, like if you've got like a vineyard for vines or almond trees or something like that, yeah.
So
This all has to be property that you can't ever depreciate your own personal property unless you use what? When could you depreciate personal property that would flow to a Schedule A? I mean personal property. If what? Yeah, if I've got to have a car as a condition of employment, I use that for my job, right? I drive my own car all over the Northwest selling, pharmaceuticals. Okay. Mid-quarter convention. This is for personal assets that you don't use half-year convention on.
So in this case, I would do 5 year. If you add that in, so on line 17, you'd add 7-year and a 5-year together.
Yep. Okay, yeah, that's a good question. So Perry said, so say that, let's just go back here and wrap this up, sorry. So let's say that these were the same company instead of 2 different examples. In year 2, if this was one company and I bought 2 assets in year 1, in year 2 his question was, would you just add 44,082 and 3840 and put that number in line 17? What do you think? Yeah, that's exactly what you do. And then you would attach that fixed asset schedule that we're going to work on Thursday to show where the heck that number came from. It's actually not required, but I'll make a pretty strong case for it on Thursday. At some point, they're going to sell the furniture. They're going to sell the inventory control system. If you haven't tracked how much depreciation you've taken on it, how are you going to calculate the gain or loss? Right? So you better track the depreciation so that when you sell that thing, you know what your AD is on date of sale. Okay, mid-quarter convention. This is only for personal property. Okay, it does not apply to any other kind of asset other than personal property. And basically all this says is 99% of the time you just get half year. But you have to run a quick check to make sure that you did not buy more than 40% of your personal property in the last quarter of the year. If I acquire more than 40% of my total assets except real estate, which is just your personal property, if I acquire more than 40% of my personal property in the last quarter of the tax year, they're not going to allow us to take a half a year in the first year. In other words, you can't use half year convention. You have to use mid-quarter convention. And that's a whole nother set of tables. And there's actually 4 sets of tables acquired in quarter 1, quarter 2, quarter 3, and quarter 4. So in that case, if I go and I do the math and it's like, what they don't want is people like going in November and buying all of their assets and then getting a half year of depreciation because you only owned them for 6 weeks. So then they're going to take you to the mid-quarter tables. Those actually aren't in our book. We have to use them in the IRS pub. And that's what I'm going to end up showing you the last couple things today, how to use the pub and where to find really the material, because I don't think the book does an adequate job of guiding you if you've never had experience with this. I mean, I use the pub all the time. The pub publication. So just to wrap up mid-quarter, and then we'll go take a look at this and then probably call it a day because my head's kind of spinning. Let's just do the math really quick and see if you can kind of apply what I'm saying here. So let's say I've got 2 situations. And I've got, let's say I buy 5 assets. Is this situation mid-quarter, and why or why not? I'm asking you to tell me the convention. Is it half year or mid-quarter? Okay, so go back and look at, let's see immediately what the questions are. That's good to do an example. So let's go back and look at this. So what it says is mid-quarter convention is required if the taxpayer acquires more than 40% of total assets except real estate in the last quarter. Must apply this convention, if it applies, to every asset purchased in the year except for real estate. So now let's go look at this again. So did you get a new lens on this? What's the calculation to see if it's mid-quarter or not? Not 7 divided by 49. The math to see is it mid-quarter. No. It excludes real estate. It excludes real estate. So what is that, ma'am? The total of all of my personal property purchases. It's not? Oh, okay. 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 So you don't really know how to do real estate yet, but I've sort of told you how am I going to depreciate my building. It's a warehouse. Okay, over how many years? It's a warehouse. Yep. Straight line over 39 years. What am I going to do with my equipment, assuming that it's manufacturing equipment? I guess you're going to have to know more about the equipment. It's qualified technological. I'm going to say, let's, for the purposes, yeah, that's not even true though. I'm going to kind of have to tell you what the equipment is. Let's just say it's 5-year equipment. So half year, mid-quarter. And how about the printer? How many years is that printer going over? Sorry, 5.
What would it be?
No,
Qualified, would it be R&D or qualified technological?
qualified technological equipment. Or really, I was always trained anything that's a peripheral device to a computer, you know, big external hard drives, printers, scanners, you know, smart boards, those are all peripherals to computers, and those are all what? Yeah. All right, let's try one more.
So if, let's say, the printer was like 10,000,
Yeah.
then it would have made it, so it had to be mid-quarter, and then it would all be mid-quarter.
And we'll see that on this one. So let's say that I buy computer-aided design, computer-aided manufacturing system, a CAD/CAM system. So I bought a CAD/CAM system, I bought a driver for my CAD/CAM system, I bought a parcel of land, and I bought a robotics system. Here's my dates. I want to know what conventions to use for each of them first. So tell me which convention you're using for each of them, and then tell me how many years you think each of them go over. And when you have that written down, let me know, because I want to go work in the pubs to do the next quick project. Ah, gosh. I can't make up numbers in my head anymore like I used to. Can you change this from 221 to 211? Does everybody have the data? you think? What was the math? First off, what can we do with the land? Yeah, straight line, and, oh, actually, that's a trick question. Yeah, NA. I'm thinking, how many years does it go over? None. So I bought, what, $357,000 worth of property, personal property? Right, so I add this plus this plus this. How much of that property did I purchase in the last quarter of the year? These two. Right? Something like that. So, did I purchase more than 40% of my personal property in the last quarter of the year? Yeah. So then you can just go, and if any year that you've got mid-quarter, everything's mid-quarter. And how many years? 5. Okay, let me just show you. I want to write you guys know how to get to forms and publications on irs.gov, right? And then you put in 4562 and get the publication up. Okay, I just want to show you what page you're on. And I know I went over, I was looking at this clock, which is 10 minutes behind our computer clocks. I'm really sorry. I was thinking it was kind of a long class. So this is publication 4562. And on page, starting on page 9, it says column A, classification of property. And here it really goes into 5-year property, 7-year property, 10-year property, more than our book does. Secondly, the other thing, this is, obviously you start with the index. This is like a 22-page document. The next thing I want to see is where the mid-quarter tables. Oh, do they not have them in here? Straight line. Huh. They may not have mid-quarter in here. That's kind of weird. Okay, so let's just leave it at that for now. For Thursday, maybe they don't have them in there. I don't know where I look them up then. But read the title. There's half year, there's straight line. I didn't see them there.
Actually, if you make it on the conventions, like
Yeah.
scroll down, it said mid-quarter.
Oh, it did?
I think it's on page 11. I saw it right there.
Okay, oh, great. Okay. Yeah, it just talks about it, right? But it doesn't give us the tables.
No, on the next page down, on the third column, right there, is that
No.
mid-quarter convention?
Yeah, but no, they're big, long tables. For each quarter, you have to pick up different numbers. I'm sorry, I'll have to find them. So here's what we're doing schedule-wise. For Thursday, we're just going to finish the lecture, so please read the chapter. And then we're going to be working on that fixed asset schedule on Excel, so, we need to really spend our time on Excel. I think maybe by Thursday, even though we haven't gone all the way through the chapter, I hate to ask you to do this, but can you take a look at the first case and see if based on what we've done so far and based on your reading, if you can kind of get an idea for where you're going with your manual recap on the first case. There's only 2 cases for chapter 7. Tuesday, my goal is to let you work on the computers all day. Thursday, my goal is to go over the homework and do another schedule, fixed asset schedule together, which you'll want to do another one of those. Next Thursday, the 10th. The 10th. So for this Thursday, you're reading and looking, I just take a look at the 2 cases and see if you can get the easy parts of the manual recap done. The wages and the... Okay. Happy day. Stay warm.